the IPO came, they raised some money. They did an equity dilution later. So debt is not the only form of raising money, but they might raise some equity as well.
Right.
If they raise equity, existing shareholders get diluted.
Correct.
That is again a problem.
Right.
So while 17 times for 100% growth looks great at a 1 year forward basis, provided they actually hit
There's
the number.
a bunch of asterisks.
There is a bunch of asterisks there.
Right.
So whether to invest or not comes not only from looking at the long term and saying, oh, beautiful sector, invest,
Correct.
but I think you've got to be very wary of the risks that come in Waaree.
Right. All right, guys, welcome everybody. We're back with episode 6 of Taking Stock. This is a weekly podcast sponsored by Paterson, where every week we pick one company, we pick one stock, and we deep dive into it. This week we're talking about Waaree Energies. Right now, let's dive right into it. First things first, there is a massive mess that's happening between USA, India, China. And Waaree as a company seems to be caught right in the middle of it, right? So if you can explain what is this mess, because it's quite confusing, it's quite messy.
Yeah. So in a nutshell, there is something known as the American Alliance for Solar Manufacturing Trade Committee.
Okay.
They have complained that Waaree Energies is relabeling Chinese-made solar cells to make in India, made in India, and selling it in the US, just to circumvent the tariffs that US has put on
China. Okay. So the US has put lower tariffs on India as compared to China.
Yeah.
So when it's made in India and not made in China, they get lower tariffs placed on them.
Yeah.
And that is the reason why Waaree's stock fell down by about 7% in a single day.
Yeah, it's been sort of under pressure ever since this has happened. Now, these are allegations. We're not saying they've done this. But what makes the allegation complicated is that one is there are tariffs between US and America. Sorry, US and China.
Right.
Then there is tariffs between US and India. There is tariffs between India and China as well.
Of course.
And in that, the allegation is that, number one, China is trying to sell their goods despite the tariffs.
Right.
And they're circumventing it through Waaree. So Waaree can be an accomplice in this.
Understood.
Or Waaree can be the main culprit.
Right.
Whatever. The allegation is on Waaree.
So this is currently at a stage where it's just an allegation. Obviously, nothing's proven. And this is an allegation placed on Waaree Energies as an organization by the American Association of Solar Energy or whatever that body is.
Yeah. So this has happened in the past as well. This is actually not the first time. There have been allegations in the past, in fact, going back all the way till 2018 when there were complaints from US Customs first that Waaree did something similar, where they relabeled stuff to made in India. Make in India is so powerful, it just comes to my mind despite not one. So, made in India, made in USA, they relabeled, and those were the claims. Those were proven wrong.
Right.
This again happened sometime in 2022, 2024, where US Customs again made those claims and duties were contested. And then Waaree sort of went and proved that they had paid enough duties to the government. Then in 2003, something else also happened where these guys randomly inspected about 200 module shipments that came into the US. Out of which 18 of were Waaree. And while, so all of Waaree's shipments were cleared off.
Right.
There was nothing fishy in those. However, the other ones, at least 22% of the others failed in those tests, which basically traced back the silicon components in the modules back to China.
Understood. And this was in 2003.
No. This has been happening since 2018 to 2024.
Understood.
Every year, something or the other goes wrong.
Okay.
Fair enough. Now, this is the latest episode where...
and unfortunately for Waaree, they are sort of caught in the middle and their stock price has taken a hit as a result of this news.
So Waaree is the largest player in India.
Right.
It has the highest market share. And in that process, obviously, they're doing a lot of stuff with the US as well. They're exporting a lot to the US. And this is bound to happen because plain numbers and volume.
So, I mean, if you zoom out a little bit, right, and just try to understand the geopolitical situation, from what I understand, there is a trade war in this sector, or in the solar panel, solar power sector, whatever you want to call it. And there's multiple countries, multiple parties involved, right?
Yeah.
And China is the dominant country in this when it comes to this particular sector or industry.
Yeah.
So, what exactly sort of causes this trade war, or what is the geopolitical situation currently like?
So, to understand the very root of it, we have to understand the fact that solar industry, whatever equipment is required, a majority of it is produced in China.
Okay.
Okay. Now we'll have to understand how it breaks down a little bit to understand why this happens. Now, when you look at a solar farm, you see these fields of large modules, right?
Those panels.
Those panels.
Okay.
Yeah. So panels and modules are interchangeably used.
Okay.
Right. So those modules or panels, they are laid in line for kilometers or whatever.
Right.
Now, modules are made up of smaller components called cells.
Okay.
So solar cells are about 6 square inches in size.
Okay.
They are put together, and that's how you make a module.
Fair enough.
The main capturing of energy is done by the solar cell.
Right.
Now, the solar cell, it kind of, you have to take a step back. This is made of silicon.
Okay.
Right. Now, silicon also, it comes in a form which is, say, cylindrical or a bulk material.
Right.
Which is, look at it as a loaf, and you're slicing
slices of bread or slices of silicon. Yeah.
So thin chips,
right,
or wafers,
right,
are cut out from this part, right, which is the chip. So there is that base material,
right,
and that base material is further, like if you take one step further back, is made from silica or silicon or sand.
Correct.
Right? So there is a purification process.
Right.
You heat it, you treat it chemically,
right.
You make it purified silicon, and then from it you make that
the loaf or whatever,
mass,
and then you the sliced wafers, as you call it.
They call it ingots.
Sorry,
ingots.
Yeah, okay. So they are what the cells are made of.
They are blocks, and blocks, you make wafers out of blocks.
Okay, and that's what I'm saying. So those wafers is what goes into a solar cell.
No, so wafers are converted into cells.
Okay.
So thin slices are just wafers,
right?
Plain, right? Then after that, it is processed with chemicals. It is coated with a metal and all of that, and that becomes a chip or a cell,
right?
And that cell is put on modules.
So using chip, wafer, getting hungry.
So that's typically this thing. So now basically all these solar components, 80 to 90% of it comes from China.
Okay.
So wherever solar energy is required, whether it is US, whether it is India, whether it is any other country,
right,
this is where the supply comes from.
Correct.
Now, because they control supply, they're doing it as scale, right? The economies of scale are massive in this.
Correct.
And also you've got to understand it is vertically integrated completely. So right from the polysilicon to the module, everything China is able to do end to end.
Correct.
So as a manufacturer, if I am making modules,
right,
but I am also making cells, I save up on margins that I would have otherwise given to somebody else.
Understood.
So if I have to cut down margins for 4 or 5 steps in the value chain,
it makes a huge difference.
I become the cheapest.
Right.
So currently, if we have to look at solar cell manufacturing, China is so cheap that the next one, say for example, India, takes double the cost of China.
Okay.
In order to manufacture.
Right.
So China has supremacy in this.
Right.
So that is the supply side of it.
Understood.
Now you come to the demand side of it. The demand side of it is simply that people are moving away from fossil
and moving towards solar,
towards renewable in general.
Right.
Now within renewable, solar is becoming extremely popular.
Correct.
We've come to a point where initially, because the scale wasn't so high and the tech was building, this entire system was very expensive to manufacture and whatever.
Right.
As the industry has evolved over the last 2 decades, it has become cheaper to manufacture. We've come to a place now where in India as well, despite all this going on, currently solar power per unit, per kilowatt hour is priced a little cheaper than coal-based power.
Okay.
So basically, it comes to some 3.2 rupees per kilowatt hour.
Okay.
And this is with storage. So
Right.
solar electricity production and storage.
Right.
Because solar is not 24 hours, right?
Correct. It's only whatever certain
you
number
need
of
to-
hours. Yeah. So
you
you
need
have to store
batteries
it.
and store and whatever.
Yeah.
So that combined cost comes to about between 3.1 and 3.5 rupees kilowatt hour. For coal, it is around 3.5, 3.2,
Okay.
3.5.
Okay.
So it's at par or a little below at this
Right.
point in time.
Right.
This is the case for most countries because solar inherently, you got to understand that once you've put a module in, the life of the module is about 25 to 30 years.
Okay.
Some modules last for even 40 years.
Right.
The capacity of a solar cell, single cell, to convert solar rays into electricity degenerates by 0.5% per year.
Okay. So before it sort of loses its value, it takes a long time.
Very long time.
Right.
Some of the components in the module might require replacement at a slightly more higher frequency. So, for example, the module is encased in aluminium. It is covered with glass on both sides. So, the glass component, the aluminium component may require change every 10-15 years.
Right.
The battery itself will require change every 10-15 years. There's an inverter which will require change every 10-15 years. However, these are all long durations.
Right.
And there is absolutely almost negligible operational cost when it comes to running the plant.
Right.
You don't have to burn something, and
Of course.
all of that is
Right.
non-existent, right? And hence, it's a very viable and it's the fastest growing source of energy. So basically, all this just to explain that there is very high demand and
Right.
supply is concentrated
with one country.
With one country.
Right.
That's why US is against China on this, India is against China on this. Everybody is saying, you know what, Chinese stuff is destroying our economy.
Right. So now India is obviously, I'm assuming, and again from what I understand over here, that China had a playbook which they have sort of implemented over the last X number of years to reach this stage, to sort of gain that supremacy, the dominance within the industry, right?
Yeah.
And India is sort of on a similar path, but at a very early stage currently.
Yeah.
And Waaree is one of the biggest players in this sector when it comes to the Indian market. Right? So what does India's sort of future look like, or where does India go from here in order to compete with China, or at least dilute their supremacy a little bit?
So just to put context, in terms of when you say India is in the race or participating in some manner, the total installed capacity in India for electricity generation would be around 500 gigawatts.
Okay.
At this point. Yeah. Out of that, solar capacity will be about roughly 19-20% or a little more.
Okay.
Or a little less, whatever, around.
Right.
So solar capacity as of 2025 is about 116 gigawatts.
Okay.
In the year 2025, India added 25 gigawatts of capacity. Sorry, this is 2024. Yeah.
Right.
They added 25 gigawatts. So that's a good 25% growth, right? How much did China add in 2024? 277 gigawatt.
So about 10 times, a little more than, about 11 times more or whatever. Yeah.
So the scale difference is humongous.
Right.
It is absolutely large.
Right.
Now they're expecting that by 2030 we will reach 280 gigawatts of total capacity.
Correct.
This is the capacity China added in one single year.
Yeah, right.
In 2024.
Yeah, correct.
So in terms of numbers, I think China's sheer scale is
you can't sort of catch up to that anytime soon.
It's far apart.
Yeah.
It's far apart, right? Now within solar, while we have a certain said capacity, right? The capacity we count when it comes to solar is the module capacity, because the module is making X amount of power.
Right.
In India, if we look at, so just to give you context here, so Waaree is the largest at 15 gigawatt capacity when it comes to modules.
Okay.
However, the cell capacity for Waaree is only 5 gigawatt.
Okay.
So essentially the deficit or the difference between 5 and 15 is something they're importing. Where is it coming from? China.
Of course.
And this ties up into the allegation.
Right.
That if Waaree is giving modules,
with cells from China.
No, but they're not making enough cells.
Correct.
Where are the cells coming from?
Right.
So it is likely, according to the US, that the cells may be coming from China and not being made in India.
Right.
And hence those allegations are also coming. Now taking a step a little above and saying that, so Waaree is the largest player. But what about India? So India, the cell module or panel capacity right now is 75 to 100 gigawatts. But the cell capacity is only 25. So we're at again 1/4 to 1/3 in terms of cell capacity. So while India is taking steps in order to ramp up on solar and really increase its size in the overall power mix,
it'll be more concentrated towards increasing the cell capacity and sort of getting it at par with the module capacity.
Yeah. So now the focus will be how do we get our cell capacity up? So whether it is India at a country level or whether it is Waaree, the initiatives are towards increasing cell capacity so that there is vertical integration in the entire thing. There is economies of scale. And at the same time, so currently what happens is while India is importing the cells, there is a 30% duty on cells. And then there are additional tariffs and duties and whatever. Some blended will come to a little higher number. But despite those 30% tariffs, when India makes its own cells, they become more expensive because we don't have the scale.
Okay. I mean, that makes sense.
So there is a difference.
So the benefits will only come in when we achieve a certain level of scale.
Yeah.
Or when I say benefits, we'll be able to only compete with China's prices and the economies of scale that they are getting.
Yeah.
Only when we also achieve a certain level of scale, which I'm assuming will take a lot more years.
It'll take a while.
Yeah.
So, and if you look at that, I mean, if you look at what's happening from an India-China perspective or a US-China perspective, the important role that any of these governments are playing is a balance because they're in a catch-22 situation. Number one, there is domestic demand.
Right.
You want to boost domestic manufacturing, but you don't have the domestic manufacturing. So you want to deter imports because they are hurting domestic manufacturing. So you're applying tariffs there, but you don't have the capacity.
Right.
So the tariffs have to come in a very gradual manner.
Correct.
So if you look at India, for example, 2022, 40% tariffs on modules, 25% on cells.
Okay.
See the difference,
right?
Come to 2025, 20% on modules, 20% on cells.
Right.
It was reduced. And similar is the trend even when it comes to, say, for example, components like solar glass, which goes on top of the module.
Right.
So there was a time when there was duty. That duty was taken off because domestic supply wasn't there.
Right.
So people are making modules.
But there's no glass.
But there's no glass. And then glass, if you import from China, it is very expensive because the tariffs are too high.
Right.
So the government had to cut tariffs and say, let's allow this because it's hurting us.
Correct.
So it has to be a very calibrated manner. And the same thing is happening in US and China as well. So US and China is actually even more interesting. 2024, tariffs were actually doubled from 25% to 50%.
Okay.
2025, it became, and this is for modules and cells.
Right.
2025, there is a 60% tariff for polysilicon wafers and cells.
60%.
60%.
Okay.
Now here's the interesting part, right? Suddenly, there is a 3,521% tariff.
Okay.
On solar cells from Chinese-owned factories in Cambodia, Vietnam, Malaysia, Thailand.
Okay. How does that make any sense?
Because what then happened is, if you put tariffs on China, Chinese-owned companies are setting up capacities in Southeast Asia.
So essentially, you're putting a tariff on anything that is Chinese-owned. It doesn't matter where it is.
Yeah.
Right. Yeah. Okay. That makes sense.
And now that goes back to your allegation. And this is why it makes sense. So
Right.
US imposed those tariffs on Southeast Asia, not in like spite for Southeast Asia,
Correct.
but because Chinese companies were circumventing the tariffs. So the allegation again is similar. Where is China circumventing the tariffs?
Right.
that's
True
where we're at.
worry.
Yeah.
Makes sense. So now, I mean, so there's two scenarios, right? Obviously, they are facing certain regulatory challenges, which makes the stock price go up or down or make it a little volatile, right? But apart from that, right, how do you look at it as a stock? How do you look at Waaree as a company in terms of its numbers, its valuations, etc.?
So one thing is established that India's solar capacity is increasing by leaps and bounds.
Right.
So the overall macro is looking good. right? You were in 2020, solar counted for about 10% of capacity, roughly about 35 gigawatts. 2025, we're at 116. 2030, we're going to go to 280 or 300.
Right.
So we are
Ramping it up, yeah.
We're ramping it up. It's cheap. It's nice. There is land available. We're doing it.
Right.
Additionally, what's happening is that Waaree is the largest player there. So module capacity, if you look at about 75 to 100 gigawatts for India, Waaree is at 50.
Okay.
So it's a considerably large
Right,
player.
right.
This is a business where, as we established from China's example, right? What is the Chinese playbook?
The economies of scale work in your favor.
Economies of scale is number one.
Right.
So size and sheer scale matters. Number two is control everything from polysilicon all the way to module.
Right.
Control
The entire
chain.
vertical integration. Yeah.
And both of these factors have a high entry barrier.
Understood.
You can't buy scale.
Correct.
I mean, you can by investing money.
Right.
You can't grow fast. There is first mover advantage.
Right.
And at the end of it, it's an industry where pricing is continuously declining over the last 20 years and will continue declining.
Right.
At least till India reaches parity with China on the manufacturing side. Now, and that is still 50% away.
Right.
So there is still a lot of room for
Correct.
downtrading of prices. So in this scenario, only large players will take it home. Waaree was
Being
a
the largest
startup
of
at
them
some
all,
point,
yeah.
and now it is the largest. So there is usually a lot of skepticism around these type of industries when it comes to larger players stepping in. This is
like
our
an Adani.
yeah, this is our warning light moment. So basically, Reliance is setting up a very large, something known as a gigafactory,
Right.
where they'll be producing cells and modules and batteries and everything.
Right.
Right? Adani is stepping into the game. So when these guys come in, and Adani is also very aggressive. So basically, we don't know the numbers for Reliance. We just know that it's some 1,000-acre property in Jamnagar and will set up, etc., etc. Adani, we have some numbers. They are currently at 4 gigawatt, and they have plans of reaching 10 gigawatt by mid 2026.
Okay.
Compares with 15 for Waaree.
Right.
So still smaller than, despite Adani being
Right.
Adani.
But it is sort of covering the gap and getting closer to Waaree.
In a way, but Waaree is also growing.
Of
We'll
course,
come to
of
Waaree's
course,
numbers
of course.
after this, but
Right.
yeah. So and then there's Tata Power at 2.5 gigawatt. So there are major players, and the major players will take home the money, right? Now, Waaree in this entire context, if I have to look at Waaree's capacity, currently wafer is at about, module is at about 15. By 2000, FY27, 15 will go to about 26.
Okay.
Okay. Chips are at, or cells are at 5. Cells will go to 15.
Right.
And then you take a step back, the base material, the slab, the loaf, that is at 0. That will go to 10.
Understood.
So you're coming to a place where we don't know what Adani's split is between the three.
Correct.
But Waaree is one player which is properly replicating the China playbook.
Understood.
At a company level.
Right.
One, scale, and number two, backward integration all the way.
Right.
Interesting part is it is not only backward integration, it is also forward integration.
Okay.
So I'll give you an example. Now what happens is, despite, it's a very interesting fact,
Right.
that India, when it manufactures modules, the total cost of making the module is currently double that of China.
Okay.
Right? However, if I have to look at the blended cost of per unit of power produced from solar energy, India is only 15% lower than China.
Okay. So what does that mean?
So basically, the equipment makes up for 40 to 50% of the total cost.
Understood.
The rest of the 40 to 50% comes from land. It comes from
labor costs, operational costs, etc.
Operational. Then it comes from EPC. So
Which
basically, procurement EPC. I can't forget the
the full form.
It's here. Put it there. So engineering, procurement, and construction.
Okay.
I hope I'm not.
I'll believe whatever you say.
So EPC essentially taking up a contract of saying that you've given me a barren land. I will convert this into a facility.
Understood.
So I'll put in modules, I'll place them, I will maintain, I will grid connection,
Right.
I'll make batteries, inverters.
So
everything.
you're saying about essentially 50 to 60% of the cost is all of this.
Yeah.
And the actual cost of the materials that go into the module is only about 40%.
40 to 50%.
40 to 50%.
So split half.
Okay.
Now, India has an advantage in terms of cost on the latter.
Right.
So we are cheap on EPC.
Correct.
We have cheaper land.
Right.
We have cheaper labor.
Right.
We have cheaper financing for renewable.
Right.
Because the government's focus is this again.
Correct.
Compared to both US and China. So while India's module manufacturing costs 2x of China, our total solar power production cost is only 15% lower compared to, more
than China. Yeah. Understood. Understood.
So that's the gap.
So that is an advantage that will sort of kick in.
So for Waaree, the point is that 2 points you're taking from the China playbook, 1 point you're taking from the India playbook.
Right.
And then
which becomes your competitive advantage in this country or this market or whatever you want to call it.
So then you've got a solid advantage where you're not only controlling backward, but also forward integration. And you've got the whole chain. These guys are also making their own, they're putting up capacity for batteries and inverters as well.
Right.
So they'll be making their own battery and energy storage systems and transmission systems and all of that, which will cover the entire chain.
Correct.
So that gives them a significant advantage again. So basically, if I have to again answer your question about what does it mean in terms of Waaree's numbers, one is that India's numbers look great,
right,
and hence Waaree's numbers will look a little better, assuming that they will gain some market share.
Right.
Assuming that,
right.
And that is currently a safe assumption to make. We don't know how aggressively the Ambanis and Adanis will come in.
Fair.
That's always a bit of a unknown. At this point in time, if I have to give you some evidence of how that has shaped up in the past. If I just compare 2 points of data, right, across 2 periods, FY23 and FY25, their revenue, Waaree's revenue has grown 2.2x.
Okay.
It's now at about 14,800 crore.
Okay.
EBITDA has gone 3.3x.
Correct.
And the PAT has gone nearly 4 times.
Right.
So they have seen phenomenal growth when it comes to these numbers.
And this is in the last... how many years?
From FY23 to 25.
So about 2 years.
2 years.
Okay.
No, I mean 23 to 24, 24 to 2. Sorry. 25 to 26. So now look at it this way. They did an EBITDA of 3,100 crore in FY25.
Right.
Their guidance for FY26 for EBITDA is between 5,500 and 6,000 crore.
Right.
So they're
almost double, about 80%.
Median is double of the guidance.
Right.
So that's what they're guiding for. So that is phenomenal growth.
Right.
And this will come from not just growth in volume, but also profit growth we're talking about, not revenue growth, right? Operating profit growth. The more in-house manufacturing you do of the components that go back, and the more you ramp up on services because the margins are higher, the more your profitability grows.
Correct.
So we've come from an EBITDA margin of 14% to 21%.
Right.
But it can
this
go
is
higher,
going to keep sort of going higher with the things. If everything's in place and whatever we've spoken about, it's only going to sort of get better from here.
That is a safe assumption to make till the time competition of this scale does not come in.
Right.
I think we have to keep in mind that currently Waaree is the single largest player when it comes to capacity. The distant second is far away.
Right.
If Adani Ambani come with an equal amount of rigor in the market, then you're talking of parity in terms of scale, and you're talking about parity in terms of integration.
Right.
And they will offer services as well.
Right.
So basically, that playbook is not going to remain exclusive any longer. That playbook is going to be replicated in India.
But I mean, just on a slight tangent, economically, if the Ambanis and Adanis sort of end up matching the scale with Waaree, let's say a few years down the line, economically, as for a country, isn't that better or is that worse that there is local competition and there is parity between 3 different players now?
It's better because it will continue reducing the price of production as well as setting up.
Right.
It will continue making solar cheaper than it already is. And end consumers will end up paying lesser for electricity.
Right.
It's great from that angle. However, is it great for Waaree in that sense? Because when larger players come in into a market which you are dominating, the one to get the hurt most is going to be the largest player.
Correct.
So while we are doubling EBITDA in the next year and whatever, there is a serious threat with these guys coming in. Also, because this is an industry where module or any component pricing has only gone downward.
Right.
And it is only going to go downward from here.
Correct.
It is going to go maybe half from here.
Right.
And if you're going to go half in terms of pricing, you might come to a point where right now margins are going up, but margins may start declining at a certain point in time.
Right. Makes sense.
So I think we are safe. I think it will follow a curve. It will follow a curve which is upward till the time your backward integration is on track. Number one.
Right.
And number two, till competition is not at par.
Understood.
That is the limited period you have for your financial supremacy to continue. After that, I would start to question my thesis a little bit.
Fair enough. Makes sense. I think that's all we can say about it, right? We can't really go beyond that. But yeah, apart from the regulatory risks that are there, and that, from what you said, is quite common in this space, everything else looks quite positive, and at least for the near future when it comes to Waaree. Great, sounds good. Should we move on to our community question for this week?
We should cover a little on the valuations of the stock.
Okay. Yes. I thought you were done.
No. So I mean, at the end of it, you got to pay a price for what you're buying.
Right.
And that price has to be determined in a certain manner, and you got to say, is it expensive or is it cheap?
Right.
So any analysis seems a little incomplete without that. Although we can't give a view on the valuation,
right?
We can give you a structure in terms of how to think about valuations in this case. Now, one thing to understand is that because scale is the game, you can't really compare it to other people and say, oh, I will compare it to Premier Energies, which has a capacity of 2 gigawatt.
Yeah, it's just two very separate scales we're talking about.
Yeah, or you can't say, oh, I will compare it with an Adani Green Energy, I'll compare it with someone. You can't do that in such a scenario. I mean, you can if you want to.
But what do you compare it with then? If you can't compare it with, because of scale, you can't compare it with a Premier or a Vikram Solar or a Adani Green Energy. What do you compare it with?
So then the valuations have to be taken into, put into context with respect to two factors. Number one, compared to history.
Okay.
And number two, compared to financials.
Fair enough.
So we'll go step one, history. Right. If I have to look at the history, you're looking at a player with limited cell capacity, great module capacity, and hence certain economics and pricing power, etc., that come with it.
Right.
Versus what you're looking at in the future is an integrated player with scale.
Right.
So the latter, or what is coming later, will deserve a higher valuation compared to what was in the past.
Correct.
That is one way of looking at it.
Fair enough.
The second way of looking at it is, what growth am I getting in the company? What financial improvement am I seeing in the company? If I'm looking at EBITDA doubling in 1 year, say for example, the market cap right now, as we today record, is about 96,000 crores.
Okay.
You've got, so it is basically 6.5 times TTM sales, trailing 12 month sales.
Right.
31 times trailing EBITDA, which is steep, and about 50 times trailing PAT. Since EBITDA is doubling, it will be roughly 17 times EV EBITDA.
Okay.
Roughly 17 times, 15 to 17 times. Let's hold it there. Now, 15 to 17 times 1 year forward, is it worth or not? Is what we need to
That's the
get.
question,
So, one point of measurement is, I'm getting 50% growth and I'm getting the stock at 17 times.
Correct.
That's one way of looking at it.
Right.
A lot of times when growth, the number and the valuation are sort of at par, it's said to be fairly
the valuation also at par. Yeah.
So in this case, because you're getting 100% EBITDA growth, but 17 times valuation, there is a disparity.
Right.
However, now you got to think about some other factors. Is that gap justified or not justified? And that becomes a little subjective. So if you think it is justified, stay away. If you think it is not justified and the gap should reduce, buy into it.
Right.
Simple, right? Now, there are to's and fro's for both, and we'll just list out the to's and fro's so that gives a little bit of a structure. Number one, I'll cover the positives first. Order book of 49,000 crore.
Right.
It's humongous. It's 3.3 times of last year's revenue.
Correct.
So basically sitting here, I have visibility of 3 years revenue, at least. Right. Number two is the movement from what we spoke about, being module heavy to actually integrating everything.
Right.
That's the second part. Third part is also entering some other spaces like green hydrogen and stuff like that. So they're, I think, also trying to shift focus from being only solar to renewables overall.
Right.
So that is a positioning change. Fourth is US market and the opportunity. Because there is a tiff going on between US and China on this. India is actually a good China plus one contender in this case. We keep hearing it theoretically, but it's a good example of how it is. And if I look at the order book right now, a lot of it, I think about half of it, if I'm not wrong, no, 40% of it is
from
overseas.
the US.
Overseas.
Okay.
That may be anything. 60% is India, 40% is overseas.
Right.
So that is supremely healthy.
Correct.
And because you also get a higher pricing in overseas markets.
Of course.
If China's tariff is at a certain level, 60%, India's tariff is lower. You can actually squeeze in that little bit.
Correct.
So those are the positives, right? Negatives, anything can happen on regulation.
Right.
India can be random, China can be random, US can be random.
Right.
2 players together are random, 3 players together are a disaster.
And we're seeing a lot of this randomness coming our way in the news in the last few weeks.
So anything with a lot of regulatory interference in a non-predictable manner, whether positive or negative, becomes a little bit of a hurdle from the investing standpoint.
Right.
Because you lose predictability.
Correct.
You lose the ability to just say that I've parked my money and coffee can.
Right.
Sorry, not that can't happen, right? That's one factor, which is a major factor. Second factor is Ambani Adani coming in,
right?
And how that will affect competitive dynamics at a later point in time. But as I mentioned earlier, maybe we've got a gestation period,
correct,
till they actually meaningfully come in,
right?
So there is a window. But again, if you know there is limited shelf life, then you might want to start baking in skepticism or some amount of deterioration today itself.
Right.
That's one point. The third and the last point is, I forgot my third point. The amount of capital expenditure that is required in the industry. At the end of it, module manufacturing is less capex intensive.
Okay.
As you go behind, the capex intensity increases.
Right.
The technical expertise, etc., increases. So basically, if I have to look at the last 5 years, they have not made any free cash flow.
Understood.
They've made operating cash flows very healthy. However, they've invested all the amount of money back into growth.
Right.
Nothing wrong in it. There is an opportunity. There is money on the table to take it. Right? But negative FCF is something where markets become like, okay, great P&L, but where is the cash flow?
Correct.
So that is a bit of an issue. If I have to look at the next year again, because the EBITDA is doubling and stuff like that, obviously they're again going aggressive in terms of capex.
Right.
The outlay for capex for next year is 12,500 crore.
Okay.
Again, if I have to put this in context, the revenue for the company last year was 14.8 thousand crore.
Right.
The PAT was short of 2,000 crore. They're investing 12,500 crore. So
understood.
Where is this money coming from? Right? If they are doing 6,000 crore in EBITDA, they are more or less converting the entire EBITDA to operating cash flow.
Right.
So about 6,000, 7,000 crores will come from there. They have 7,000 crores of cash on the balance sheet, which they obviously won't fully utilize. They may take up some debt. Currently, they're negative on debt to equity.
Okay.
If they take up some debt, it will reflect on balance sheets. Because then, whatever, it's a problem. Not a problem, but
the debt equity ratio changes, basically.
The other thing is that the IPO came, they raised some money. They did an equity dilution later. So debt is not the only form of raising money, but they might raise some equity as well.
Right.
If they raise equity, existing shareholders get diluted.
Correct.
That is again a problem.
Right.
So while 17 times for 100% growth looks great at a 1 year forward basis, provided they actually hit the number.
There's a bunch of asterisks.
There is a bunch of asterisks there.
Right.
So whether to invest or not comes not only from looking at the long term and saying, oh, beautiful sector, invest, but I think you've got to be very wary of the risks that come in Waaree.
Right.
Beautiful line. So yes, that's where we'll probably conclude.
Okay. So next thing now, as we do every week, right, we're going to go into our community question. We get a lot of questions across our social platforms. And every week we pick one question and sort of try to answer it in the best possible way. This week we've got a question from Shail Patel from New Jersey. And it's a very interesting question. That's why we sort of picked this. The question is, in the US markets, there's a saying which says, sell in May and go away. Now, the question here is, what Shail's asking is, does it apply for the Indian markets as well, right? So I think first thing probably for everybody listening, you might want to explain this saying and the sort of fundamental reasoning behind why this is a popular saying, where sell in May and go away. What does this mean?
So if you sort of analyze data, right, you figure that the US markets go through their worst period on average between May and October.
Okay.
So
reason being?
It's just a spurious correlation.
Okay.
It's got nothing to do with... it's just data and you find a correlation.
Fair enough.
It's like when pigeons fly west, oil production increases.
It's got nothing to do with it.
It may be correlated. I mean, the data might show up at the same time or down at the same time, but it's not correlated.
Correct.
So it's one of those things.
Okay.
So there's a popular saying that, fund managers make all their money before May. And then they go away sailing or they go away on a holiday and then come back in October prepared for like the next money making season.
Right.
But there is there's no underlying weight to it.
Understood.
There's also something very interesting, which is the Santa Claus rally, which is the Christmas period usually gives phenomenal return.
Okay.
That may have
I'm assuming increase in consumption overall across the world, essentially.
No, but why does the market only go up at that time? Markets and economies are not necessarily one-to-one real-time correlations.
I know. True,
So,
of course.
I mean, these are correlations that keep coming up and going. Maybe applicable for the US
but
market.
Is there a correlation? I mean, I know I'm going slightly away from this question here, but it's interesting that is there a correlation between the Indian festive season and the markets?
Yeah, optimism definitely increases. Even this time, if you look at, there is a lot of optimism built around the festive season.
Right.
Because people spend their money.
Correct.
In India, people buy stuff, new clothes and stuff like that.
All of that,
Holidays, it happens during the festive
gifting,
season.
etc.
It also comes after the monsoon. India being a very monsoon-dependent economy from a rural standpoint, agriculture standpoint, a lot depends on how good the monsoon was.
Right.
So if the monsoons are great, people save up or have a lot of money to spend during the festive season.
Right.
And this year, especially, there has been
GST cuts.
The GST cut is more recent, but the budget itself had announced tax cuts.
Right.
So starting from there, all the way till GST cuts, we've seen several initiatives by the government to boost consumption.
And if I'm not wrong, the monsoon has been favorable for India this season.
Erratic, but good.
Right.
So, I mean, there were some issues like late delay, early start. Because of the AC sales drop and stuff like that. So random things keep happening.
Right.
But yeah, festive seasons usually, like this time, it's being looked forward to. So there may be a correlation between the rally you're seeing in recent times and what you're looking for.
Even today on the day we are recording this, we've already got some numbers where auto sales are sort of going through the roof and are predicted to sort of continue towards the end of the year.
Yeah.
Okay, anyway, so coming back to Shail's question, does this saying apply for Indian markets as well? I'm assuming not.
No, I mean, I'll have to go and check the data to see if it applies, but even if it applies, it's not to be taken seriously. Don't take it seriously in the US itself, forget India.
Fair enough. So don't sell in May and go away.
In fact, keep buying, right? I think it's a great opportunity. I would kind of twist this around and say that SIPs should continue during rough periods.
Right.
Because when the markets are not doing well and you're actively investing during that period, you're actually reducing your average rate of buying.
Right.
So, sure, sell in May, whatever, continue your SIPs.
Fair enough. On that note, I think that's all for today. Thank you so much, everybody, for listening. We do podcasts every week. Every Tuesday, our podcasts go live. So stay tuned. Thanks a lot.
Disclaimer. This content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.